don't think it's much of a secret, but on the 2024 campaign trail, Donald Trump promised no tax on Social Security benefits. Let's take a look.
To help seniors, we will have no tax on Social Security benefits. That's a big deal. I don't know. I'm trying to figure for restaurant workers, and all workers, tip workers, it's no tax on tips, but the Social Security, no tax, because they've driven them out of business. These people have suffered, and they've done things the right way. They've saved, and then the inflation destroyed them. And we're going to have no tax on Social Security benefits, and that's a big thing, and it's very important.
But in order for that to happen, we also need to talk about how the process would work. If you're watching this in early 2025, you've probably seen that President Trump has signed quite a few executive actions. However, ending the taxation of Social Security benefits as part of one's taxable income is going to require a little bit more than just executive action. It would require congressional approval in order for this to happen. We're going to talk through the process in order for no tax on Social Security benefits to take place. We're also going to talk through a couple of bills that have been introduced by both Republicans and Democrats. And most importantly, we're going to talk about how this actually affects you and what you can do, whether Social Security benefits will remain taxable or not. But what we first want to talk through is how Social Security is currently taxed and a brief history on the taxation of Social Security benefits. So back in 1935, when Social Security first came onto the scene in the United States, there was no tax on Social Security benefits that were received. This changed in the 80s under the Reagan administration when 50% of benefits over a certain income threshold would become taxable. It changed again in the early 90s under the Clinton administration, where up to 85% of benefits could be taxable for retirees. Now, the way that this would be calculated is based off what's known as provisional income. And provisional income is where you take half of your Social Security benefit, you take your ordinary income, you add to that any dividends and capital gains, and you also add any non-taxable interest back to that. And that's what calculates your provisional income. So those thresholds that you just saw are really not what's applied to your ordinary income, but to your provisional income. Something that I think is also pretty alarming in some respects is that the provisional income figures and those thresholds that you see have not been adjusted for inflation. So again, if we're talking about the early 80s and the early 90s, 30 to 40 years ago, what we're noticing is that inflation has gone up quite a bit in the last 30 to 40 years. So while a much smaller segment of the population was affected when these thresholds were first introduced, we've seen, especially in recent years, that more and more people are beginning to cross this threshold, and therefore retirees are seeing that some portion of their benefit is becoming taxable. Generally, there are two arguments for and against this. So the first argument for this would be that Social Security solvency is becoming a glaring issue, and taxation on some of these benefits are added back into the system. Therefore, anything that would be collected would be able to help keep the system solvent for future and current retirees. On the flip side, some would argue that as the employee, you already paid that payroll tax on the way in. That 6.2% of your wage base was taxed, and therefore it would be a double tax. You've been taxed on the way in and taxed on the way out. So again, we're left at this crossroads between, is it fair to tax seniors on their Social Security benefit when they've already been taxed? But at the same time, is it fair then to continue to put a drain on the Social Security solvency issue? How the process legislatively would be concerned, that's where things can get a little dicey. And I'll be the first to admit, I'm not a political expert, so I can't tell you exactly how this could go down. But based on how some of this currently lays out, there are a couple of things that would need to happen in order for this to take effect. In the House of Representatives, a simple majority will do the trick. Now, currently, Republicans hold a very slim margin in the House, but chances are good there could be one or two defectors in either party, which could give a bill the required votes needed in order to pass. Now, in the Senate, it's a little bit different. Republicans currently have enough seats in the Senate to pass some legislation, but they don't have the 60 seats required in order to pass without a filibuster. Now, there is a process called reconciliation, which could take place, which doesn't require 60 votes, but only a majority of votes in the Senate. So the Republicans would only need 50 votes, assuming that Vice President Vance would be then the tie-breaking vote, to give the Senate the 51 votes needed. But with the reconciliation process, there are limits in place. Specifically, the bill must be directly impacting revenue, spending, or deficits. So these provisions must be related to the budget, meaning that the process can't be used for something that would be non-budget related. I think it's pretty fair assessment that both parties have made it clear that they want to cut the tax of Social Security for retirees. However, both sides also are split on whether or not the solvency issue is something that they want to tackle right now. Let's first start with a bill that was actually introduced in the beginning of 2024 by Representative Angie Craig of Minnesota. She announced legislation that would eliminate taxes on Social Security benefits for seniors while also trying to address the issue of Social Security solvency. The way in which she would help to solve the solvency issue was by raising the cap of Social Security benefits that would be considered taxable on the payroll tax side. This act is known by the You Earned It, You Keep It Act, and I'm putting a link in the description so you can actually read it for yourself to understand how this works. Republicans, in the meantime, have actually introduced two separate bills. One that also was introduced by a House member, Representative Thomas Massey. This one is a little bit shorter in length because it doesn't have quite the provisions that would include addressing the solvency issue. There's no tax that would be generated to help offset the cost of eliminating tax on Social Security benefits. This act, similar to the You Earned It, You Keep It Act, would also look to eliminate tax for Social Security benefits for retirees. This act is known as the Senior Citizens Tax Elimination Act. So, again, something that Republicans are looking to do is to eliminate the tax on Social Security benefits. But the difference between this bill and the Democrats' bill would be that there is no mention of any way to raise additional revenue. Meanwhile, Republicans in the Senate have also introduced the bill. Republican Senators Blackburn and Marshall have introduced a bill which would look to kind of find a compromise between the two. This bill, which has a long name, so I'll just refer to it as the Retirees First Act, would look to at least increase the thresholds and put an inflation adjustment on some of those thresholds to make sure that retirees don't experience what's known as bracket creep like we've seen in the last 30 to 40 years. I'm putting a link to the description of this act as well. But one of the main highlights is that they would eliminate the 50% threshold that was first put in place in the 1980s and just keep the 85% threshold. They would also raise that threshold for married filing jointly recipients to 68,000. Single filers would stay at 34,000, and if you're married filing separately, it would continue to be the case where 85% of your benefits would be taxable. One of the other big things is that it would address the inflation adjustment issue that we did not have from the 80s to the 90s to up until now. So it could help for seniors when it comes to bracket creep. In order to address the issue of actually raising money, they have talked about taking non-discretionary funds and actually utilizing that to help pay for any of the difference that could take place. One other thing that Washington will need to figure out this year is a sunsetting of the Tax Cuts and Jobs Act, which first took place back in 2017 when Trump took office and really began to take effect in 2018. It'll be expiring at the end of 2025, so Congress will also need to decide the future of what's going to happen to the current marginal tax rates, in addition to what they're going to do with some of the credits and deductions that are currently in place. So let's first start with what's actually going to happen. To answer it bluntly, I have no clue. And I think what we want to make sure of is that there needs to be enough support in Congress for both the solvency issue and cutting or eliminating tax on seniors when it comes to their Social Security benefits. Republicans currently hold a very slim majority in the House and a little bit more comfortable majority in the Senate. President Trump again did mention on the campaign trail that he would like to eliminate all tax for Social Security recipients. But again, the question becomes, is this a situation where compromise can take place, or will both parties continue to dig their heels in the ground? It's important to make sure how we understand how Social Security is taxed because that will have a huge impact, I think, on planning options. For example, if you have non-qualified accounts, you could find yourself in a lower income tax bracket and take advantage of stocks or funds that have a low cost basis. In other words, you have to pay that via capital gain. Social Security taxation could also increase the amount of taxable income that you're bringing in, which decreases the amount of the 0% bracket that you have available to you. If the taxation of Social Security is eliminated or cut back, that may offer more room in your capital gains bracket of 0% that you can take advantage of. It can also lower your marginal tax bracket as well. And by lowering your marginal tax rate, you could be lowering your effective tax rate. In other words, how much you're actually paying into the government at the end of the year. One other big key for retirees are the Medicare premium surcharges that take place when you have too high of a modified adjusted gross income. If your Social Security benefit is taxable, that's added back into your modified adjusted gross income and can increase that amount, which would lead to higher Medicare premium surcharges that you'd have. So if Social Security benefits are not taxable, or again, not as much of your benefit is taxable, it could give you some breathing room to make sure that your Medicare premiums would not be subject to an additional surcharge. But there are two things that we want to make sure of when it comes to Social Security planning that are going to stay true regardless. Number one could be the benefit of delaying. And if you continue to delay your benefit, you could notice a higher benefit regardless of how much is taxed. There really is not one standard answer when it comes to when you should collect Social Security, whether it be early or late. But one strategy that could come into play is a Social Security bridge strategy. And I'm linking to a video right here. Another thing that could take place for you is if Social Security benefits are not taxable, you could find yourself in a better position in which you could utilize Roth conversions. And Roth conversions can greatly decrease the amount of taxable liability you pay in your lifetime. For that, you can click right here.